Kevin Giddis, your world, are you positioned for the flattener?
Well, we have. I think we've been expecting a flattening curve for about 4 years now, not just this year.
Yeah.
I think right now the flattening of the curve is fundamental to the two issues that are going on. The Fed is certainly pledged to keep raising rates, and the lack of inflation, or just the new kindling of the inflation, is starting to press those together. Right now it means very little, other than that at 303 it was a great point of resistance and actually brought more buyers in than sellers.
Yeah.
So it kind of validated that 3% really didn't mean a whole lot. But as the year goes on, you can take out 303, you can take out 310, although I think it's unlikely that you're going much higher than that.
And just in terms of the flattening yield curve, I mean, Keith Parker, in the bond market, you can make money playing the flattener, but I would put the emphasis on flattening. It is not flat, it is not inverted, it is flattening. And in that world, risk assets can still perform. The equity market can still outperform, and it's several years before we even have to think about recession. Is that the way you think about this too? That ultimately, sure, it's fine if that's what you want to do in the bond market, but the consequences for me in equities aren't big yet and not for a while.
Yeah, I'd say a couple points. Number one, the equities don't like a steepening in the curve. That means growth is disappointing and we're worried about inflation. That hits the multiple based on our framework. And the other is simply, if you look at those points when you're getting close to inversion and after, the equity market returns 20 to 30%. And so, if you're an investor, do you want to worry about that that recession 2+ years from now, or do you want to play for what we think is considerable upside still left?
Late cycle upside. Neil Dwane?
Yeah, what I would say is I think the other technical factor which we're all wrestling with is quantitative tightening. I think we know the Fed is generally going to increasingly let more of its balance sheet roll off. That is coming at a time when the Treasury, as you highlighted in your opening comments, is printing US Treasuries like they're going out of fashion. So we're getting a supply issuance, and I think that is tightening the markets. And we're seeing that in the damage being done in the HKMA, having to intervene in Hong Kong. I think we're seeing the global pool of dollars being priced higher. And therefore, the easy trades of 2017 are beginning to change. The volatility of February, I think, has changed the value at risk in many portfolios. So I still think we're in a period of deleveraging because the cost of capital is rising.